Okay, the next three chapters in our book have to do with measuring financial performance, uh, evaluating financial performance, and then ultimately short and long-term financial planning. The book, I think, does a pretty detailed and a very adequate job of trying to portray the financial concepts of testing your decisions in what we call the economic model. This is very much the model of the four M's. This is the economic model. We're going to use a case called Glak Love. Um, Glak Love starts with a very interesting story, and let's take a look at their website. Angeline Pass is a dear friend of mine. Um, she is a very, very accomplished young woman that had a very interesting idea that started in an unexpected way. She happens to be a burgeoning actress in Atlanta, has been on some kind of an extra on some large films, but has done a lot of stuff in theater around the area. And for whatever reason, and you can go read her story on the website, she decided one evening to sit around and uh, play around with some old film. And what you're looking at is film negatives. At the upper side of this site right now, you can see a picture and it looks very much like Angeline, by the way. Well, actually, there's a picture below here of Angeline. There she is. And you can talk, read through her website and see how she came up with this. But effectively, she was creatively took film negatives and originally turned them into jewelry. And of course, as you can imagine, she built a piece of jewelry for herself. She wears it. Some of her friends go, wow, that's really cool. Because if you look at the piece of jewelry, you can also see the film, the whatever she created with those film negatives. There's a story within the story because the film negatives came through. And what was interesting about that was that she started like a lot of small businesses do with ideas. Is she did something that she thought would be interesting for herself. Her friends and family started wanting copies of it, and the next thing you know, she started being asked to sell these, and we'll give you a little bit more of that information as we proceed. So the first thing we need to do is go through and again take a look at the 4Ms here. All righty. So the marketplace. Interestingly enough, and I'm not sure that comes through quite in the website now, the original product was jewelry. As Angeline started experimenting with products, she also happened to uh, decide that perhaps it might be interesting as a Christmas ornament. And I think if you'll look over a period of time, what's happened is the vast majority of her sales are now in the Christmas ornament business. Those things took off, and when you look at her website, you'll be able to see that. Um, there was a very interesting, we've talked about her background under the management end. She's never built a company before. She's not uh, a retail expert, but she's fast becoming one. And she has evolved her product originally from jewelry to her best sellers now are obviously the Christmas ornaments. Now, there's an interesting story about the model. What you originally had was custom jewelry, and when Angela and I sat down and talked about uh, how she would scale this business, she was presented with a very, very difficult decision, a very interesting one, to say the least. In one respect, she could position her ideas as original art. And she actually has been commissioned to do some original art, I believe, for a hotel, whereby she would be paid as an artist. The pieces that she delivers are original. They're all hand done, and you have no idea. I can only imagine how much time and attention to detail it takes to build some of these gorgeous things that she's done with a piece of scissor and old film negatives. But if you are going to create a business at scale, she had to deal with the fact that she couldn't build each original artwork at scale. You would never, ever, ever be able to get enough of these things out to the marketplace. And without giving any of her trade secrets away, one of the things that she did is she figured out a way to multiply the original art through photography and create the original product at scale, and to drive the cost down where she could effectively sell for example, the same artwork in thousands and thousands of Christmas ornaments at a price that she could make money in and her retail partner could make money in. So she solved that issue, but she still has a very interesting logistics issues and problems. She actually manufactures those products herself at this point. And a lot of this future of her business and the future of the things that she is figuring out and very rapidly doing some has to do with the seasonality of this business, which means you have to get most of this product up and ready to ship before Christmas. How do you do that efficiently and effectively? And she's getting her hands around those issues as we talk about. Now, I want to give you a little bit of background on where the money came from. In this situation, I'm an investor along with her family. This is what people refer to in the business as friends and family rounds. I didn't approach this with the idea that the single most important driving issue is how quickly can we build this thing and sell this thing. Angela and her family are dear friends of mine. I was highly interested in Angela's ability to creatively come up with this idea. We are very, very long-term patient investors. Valuation issues are not important to us. And I want to contrast that to an angel deal, which we'll do a little bit later on in the class, where it is very much about how much money we can make and how fast we can make it. And I think the differentiation between the friends and family type of financing is that there is a significantly different attitude about why and how that money goes to work, as opposed to what we would call professional angels, which are really doing the first stage and taking the most risk in an early stage company, hoping to get it up to where professional VCs will take a look at it. So with that, take some time and look at this website, a little background on the type of product and how it came to be, and why it's unique. I think you guys, just like we do in my family, we buy them every year, and I think you'll find it very interesting that she has become very, very successful at designing these things. And the next step of this, however, is that we've got to teach you how to understand the financial model of a business, which requires that I teach you accounting. God help us. Some of you have had accounting, some of you haven't, some of you have had finance, some of you hadn't. But what we're going to do is we're going to catch you up to how you understand, how you test your decisions, how you test your economic model in advance of actually the business executing on that model, so that you can make the right decisions and understand the difference, for example, between the profits you're making, or how much profits you can make, or how you can price a product, and also the cash required in order to actually run the business. So with that being said, we're now going to go to look at a schedule or a model, and we're going to start teaching you how to do a forecast and a significantly simpler way, I think, than most textbooks try to get you to engage. Now, for this week and the next 2 weeks, you're going to get to know this worksheet very, very well because the absolute bulk of your casework responsibilities are going to be around completing the worksheet, which I'm going to go over with you to start with today, and hopefully give you an example of how to think about the business in the context of financial terms. So the first thing I want you to look at is that let's assume that Angela and Glak Love are approached by a large department chain. They've seen her product out and about in small boutiques. They've seen it on the internet, and they believe, like we believe, that this is a very differentiated product and that they can sell it for somewhere around $20 retail, which means they've come to Angelin and they've said, Angelin, we'd like to buy 10,000 units of your product for the first month, and we're going to put it in the stores and test to see whether it sells. And Angelin, we're willing to pay you $10 for those units and buy them from you, but we're not going to be able to pay you until the end of the following month. So you ship it to us in September, we sell them, we'll pay you for September's sales in November. So take a look at the revenue section right up here. I think you can see my cursor. The first month of operations, 10,000 units are sold. We'll get to the second and third month in a second. The cash flow characteristics of the revenue are that goods are shipped at the end of the month, are paid to the company, Angelin's company, Glak Love, at the end of the following month by customers. Now, so now we know what our revenues are looking at. So let's take a look down here and let's take a look at our first month. By the way, we are going to start this business with $75,000 cash from friends and family. So we are in our checking account, we have $75,000. Nobody owes us anything. We don't owe anybody else on our accounts payable, but our owner's capital is $75,000. Now let's take a look at that. 10,000 units times $10 a unit is $100,000 in revenues for the first month, okay? Now, let's go take a look at our cost of those ornaments that we're shipping. And they're made up of different components. And we have three different components here. The first is the direct materials. The direct materials would be the glass bowl. The direct materials would be the packaging. The direct materials would also include the cost of the film negatives that are mass reproduced around the original artwork that Angelin designs. And we're going to suggest that that actually is $2 a unit. Now, it takes folks to put these ornaments together. And Angelin actually originally, which is very, very cool, arranged for a woman's shelter that was put together to protect women in Atlanta that were being abused or were caught up in the unfortunate sex trade that's so prevalent in Atlanta. And these women were separated from the evildoers and protected, but they were looking for ways for them to make money. So there were some opportunities to get them, and let's assume that that's still the case. It's not the case at this point, but that was some of the ideas around this. The direct labor cost would be $3 per unit, okay? And that is how much it was going to cost for Angelin to have these things put together. At this point in time, they've outgrown that situation with these young ladies, and they're actually building these things internally. The other thing is that there are certain fixed machinery and manufacturing and rental for the space rental costs that were going to be needed to run this business. A place to manufacture, a place to design. The price for the first month was $10,000 for the fixed machinery and equipment, and all of this right now is being paid up front to an outsourced manufacturer. That's the case parameters. We've given you this to keep this a little simple so you can understand the cash flow mechanics of what's going on. So in summary, our cost of goods sold is $2 per unit plus $3, which is $5 for the first month. $10,000 a month for all the other things have to be paid up front, and when they give us, we pay it up front, effectively we get our 10,000 units we can ship to our customers. So let's go down and take a look at that. So the direct materials are going to be $2 per unit times 10,000, or effectively $20,000 for the month. All right. Our direct labor is going to be $3 a unit times 10,000, or $30,000 for the month. And as we indicated earlier, we're going to spend $10,000 for the machinery. So our total cost of goods sold is $60,000. Everybody see that? Okay. Now, we also are going to pay salaries to Angela, $10,000 per month, okay, and other folks that are helping box, ship, and take orders. So the total salaries for Angela and her staff under this case, and these numbers are fictitious. I don't want you to think these are exactly what's going on, but these are designed to give you an idea of what potentially would be the situation. So they are literally $120,000 per year for everybody, $10,000 per month. There's a fixed rate contract for advertising of $3,000 per month. Office rent for the administrative part of the thing is $4,500 per month. Insurance is $1,000 a month, and they have to be paid during the month they're incurred. In other words, they are paid every month, regardless if there's any revenues or sales. So let's go down here and take a look. So the salary, $10,000. Advertising is $3,000. Oops. Okay. Office rental, $4,500. Insurance, $1,000. For a total, backspace this thing here, for a total of operating expenses of $18,500. So let's take a look at our profits. We have received, we sold $100,000 worth of units. The cost of those units were $60,000, which we paid to a contract manufacturer up front. We paid $10,000 salaries, $3,000 in advertising, $4,500 in insurance, office rental, $1,000 in insurance, for a total of $18,500 in operating expenses. So our net profit is $21,500. Now, conceptually, what I want you to understand is that accounting can best be understood as a photograph and a video. If you want to look at a balance sheet, this is our opening balance sheet over here. That is a photograph of the business that when we started. we photographed the business, and what do we have? It showed that we had assets of $75,000. We had no liabilities, and who owned those assets, which is what the accounting equation of assets equals liabilities plus owner and their equity is all about, is if you have assets, we want to know who owns them. Are they owed to somebody? We have zero liabilities. Are they owned by the owners? And there it is. So there's your 75 grand. There's your $75,000 in cash. Now, what accounting is all about is literally taking another photograph of the business at the end of the following month, and there's going to be a change. The income statement and the cash flow between the two photographs, that 30-day period, they are the video that explains how this photograph of the business changed to this photograph of the business. So let's take a little look at the end of the first month, and let's take a little look at what is going on. Well, the first thing that we need to understand is that we are owed $100,000 from a large department store. As you can see, we sold them $100,000. They haven't given us any cash, right? Because they don't pay until the next month. So we got zero cash in for this month, and we do owe, or we are owed $100,000 in receivables. So that's a picture of the business there. So we'll get to cash in just a second. The second thing is, do we owe anybody for our cost of goods sold? No, we don't owe anybody for our cost of goods sold, which is our direct materials, our labor, and machinery, because what did we do? We paid for those numbers, those amounts, during the month. So we paid $60,000 to the contract manufacturer during the month, right? So let's go back up here and actually show this as cash going out of the business. And we show the fact that we don't owe anybody anything in terms of an accounts payable. Certainly don't owe anything for advertising, rental, or insurance because we paid those. In fact, if we sum all those up, they were $18,000. Let's see, where's the backup on this thing? $18,000. Let's do it this way. Outflow of cash. There we go. All right. Now let's take a look then. If we started with $75,000 in cash, right? That's this picture of the business we start with. We got zero cash in from our revenues because we're owed $100,000. But we paid, if you will, $60,000 in checks there, or $160,000 for the materials, labor, and machinery. And then we paid $3,000, salaries, $3,000, office rentals, insurance, $18,000. Actually, it's $18,500, excuse me. Okay. So as you can see, we have a total of $78,000, $78,500 that we have written out of our checking account. Does everybody see that? That's the combined amount of bills that we paid for the month. And let me squeeze that out a little bit. Okay, now, so if we started with $75,000 in your checking account, we got zero cash in, we paid a $60,000 check and a combination of other checks of $18,500, I think it's pretty easy to understand that our cash balance now is not $75,000. It is what? It is a negative $3,500. Okay? We're owed $100,000. Therefore, our total assets in this business now are $96,500. We don't owe anybody. We have owner's capital originally of $75,000. So we have $96,500. How much of that was the original money that we put in? $75,000. And then how much did we earn? Well, we actually made $21,500, right? $21,500 for a total of $96,500. Total owner's equity is $96,500. So let's review this for a second. We started with $75,000 in cash. We sold $100,000. We didn't get paid for it until this following second month. We have the following costs: $60,000 for our contract manufacturing, $18,500 for our operating expenses. We wrote checks for $78,500, so we're overdrawn for $3,500. We are owed $100,000. That's an asset. So we have gone from $75,000 in total assets to $96,500 in total assets, which, as it turns out, happens to be the amount of net profit. So it is very, very important for you to understand is that profit is not the same as cash flow. We went down in cash, but we went up in assets. Okay? Now, what I'd like you to do is now let's take a look at a couple of things that relate to the second month. So going down to the second month, let me do a couple of these for you because your assignment is going to be to complete this this worksheet. The second month, we're going to sell 20,000 units, or let's put it this way. Angeline is called back into the office by the large department store. And they tell Angeline, we sold out the 10,000 units. We want to continue this relationship, but we want a discount, okay, on the units going forward. And we will agree to buy 20,000 units the second month at $8 a unit, and the third month of operation, 40,000 units at $6 a unit, okay? Same thing, we will pay you the next month. You know we owe you $100,000 this month because of last month's sales, and we're going to send you a $100,000 check. But we want to effectively buy 20,000 units, and then the third month, 40,000 units. Now, you go back to your contract, Angela goes back to her contract manufacturer and says, I'm going to buy a whole bunch more from you. And they say, well, we're going to have to buy some more machinery, so we're going to have to go from $10,000 a month, as you can see, from our fixed machinery to $15,000 a month in month 3. But in the third month, we'll give you a break off your direct labor costs because we'll be more efficient. So what I'm doing is I'm giving you a different set of circumstances in the business. And what these next 3 chapters in the books are all about is how do you test the economics of the negotiations, of the future state of the business, to determine 2 things. Are we going to make any money at it? And also, do we have the cash flow to fund it, which tees up the funding issue that we'll talk about going forward. So now with that said, let's just take a couple of look-sees here. So for example, just to show you how this would work, obviously the second month our revenues would be $180,000. Okay, our direct materials would be $40,000. Now where did I get $40,000? Well, the second month sales are what? 20,000 units. Okay. By the way, the 180,000 is 10,000 at 10, which is 100,000, and 10,000 at 8. That's your $180,000. Now let's go down to direct materials. we've just walked through how revenues are $180,000. Direct materials are going to be literally 20,000 units at $2 a unit, or $40,000. See how this works? Direct labor is going to be 20,000 units at $3 a unit, or $60,000. Our costs go up because our volume is going up. Okay, and the machinery is going to remain at $10,000 for the second month. Remember, under the case, it's going to go up in the third month, and our direct labor costs per unit is going to go down. So a total of $110,000 is now incurred in the total direct cost of goods sold. Salary, all the salaries and everything remains the same, so I'm just going to skip down here and show it as $18,500. You guys can fill in the details when you do your own schedule. So if I have $180,000 coming in, I have cost of goods sold of $110,000, which leaves me $70,000. $70,000 less my operating expenses of $18,500, excuse me. Gives me a net income of $51,500. Let's back that up and put a comma in there. So we went from making $21,000 in the first month and our cash balance going to negative, to the second month making $51,500 in the second month. So our cumulative assets are growing. But let's look at our cash flow. All right, so the first thing, are we going to get any cash in? Yes, we're not going to get the $180,000 in. We're going to get what? The $100,000 from last month's sales. They paid off their receivables. Are we owed a receivable for this month's? Yes, we are. $180,000 is now owed to us for this month's sales. Did we pay off? Do we have any debt to pay off or any vendors we owe? No, because we pay that literally as we go, so we don't owe anything in payables. All right, and but we do end up having $110,000 go out the door because we had to pay our contract manufacturer. And we also had to pay our normal operating expenses of $18,500. So what happened in our cash flows, we had $100,000 come in, we had $110,000 go out, and another $18,500 go out. So effectively, our cash went down $28,000. Our checking account went down $28,500. Now, let's take a look at that. If I started off with $75,000, see my cursor? I wrote checks for $78,500. I have a negative $3,500 balance. Okay? The second month of operations, my sales went up, my profits went up, $51,500 more, but guess what's going to happen to my cash flow? I'm now at a negative $3,500. I'm overdrawn in my cash account. I can't call Dad and say, Dad, cover me. I got $100,000 in. I wrote another $110,000 check to our contract manufacturer and $18,500. So I have an additional overdrawn amount of $28,500. So if I take where I'm already overdrawn $3,500 and add 100, take out 110, take out 18,500, guess what? My new cash balance, I am now $32,000 overdrawn in my account. What are my net assets? Well, I have $180,000 owed to me. My net assets, because I owe that money back to the bank. I'm now at $148,000 in assets that the business has. I don't owe anybody. My original, so if I have 148, who owns it? Well, let's go back and start with the original $75,000. Part of that is the original $75,000, and guess what? I have increased my assets by a total of $73,000, which interestingly enough is, excuse me, I got these in the wrong spots. There we go. Put that there. Let me drag it there. So of the 148,000, 75 was originally in the business. 73 is the amount that the total assets, which amount to $148,000. How that $148,000 breaks down. So here's the original photograph of the business. Here's how the business looks at the end of the first month, and this explains what happened. We made money, but we drove to a negative cash flow because our assets are receivables, they're not cash. Second month, revenues went up, even made more money. We're now in an even more difficult place where cash flow is cumulatively negative $32,000. So let me get out of this and let's go back to the slideshow and we'll talk about what you need to do going forward. Okay, your assignment for this week is to take that worksheet and complete the forecast model from scratch. You'll be able to get the forecast model on Blackboard without numbers in it. Complete that for the first, second, and all the way through the third month. Remember that the third month changes the cost again for both what you sell in revenue and what your cost of your, I believe it is your direct labor and your direct and your fixed equipment costs are going to be, so that you can see what the picture of the business is going to look like in the third month. Now, this is an exercise that I want to encourage every one of you in the class to collaborate on. We're going to set up a collaboration forum. Some of you will figure this out based on my experience teaching this over the last couple of years. Some of you will intuitively figure this out. Some of you will struggle with it. And what I want you those of you that have figured out to do, to lend your understanding about how you crack the code to those that are struggling with it. A little caution, you cannot memorize this stuff. You have to understand what is going on in the business and how the fact cases of what drives the revenues and expenses actually turn into numbers and how those numbers work through both the balance sheets, the cash flows, and the income statements, which is what the next three chapters are all about. So good luck, and make sure that you look for a collaboration forum. And there is no cheating. I want everybody to figure this out, help each other, show them how you got the answers, and good luck.